Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this week it's been relatively quiet on investment markets. We've continued to be range bound almost in every equity market you care to look at, particularly in the US. There's the 3,000 level is proving pretty tricky for the S&P 500 to overcome, but I'll come on to that a little bit later. But just to give you a recap of some of the things that have happened in the last week, we had Jerome Powell, the chair of the US Federal Reserve, talk about the potential recovery in the US and that it may take longer than people think. We might not quite have the V-shaped recovery that some people are hoping for. We had Warren Buffett actually disclose not only has he sold out of airline stocks, but he's also started to sell out of financials. And now financials are a key sector if we are going to get an economic recovery. Again, something I'll come on to later. We had another round of hopes for a potential vaccine from a company, which again, we saw their share price rally and then pull back. We're getting a lot of headlines around potential vaccines, which are shifting markets. So the market at the moment is trading very much on hope. There's a lot about headlines that are driving investment markets. So we get quick periods of rallies, the fear of missing out. In fact, that FOMO, we've probably seen more FOMO this week than we have at any point in about the last 20 or 30 years. And the reason I can say that is if you compare the number of upticks on the S&P 500 on a particular day, it was on Monday, in fact, versus the number of downticks, then it was the biggest range that we'd seen in that period. So it was almost as if the market just continually went upwards. So that FOMO is almost uniquely American, as I've been talking about, because if you went across to Europe, to the UK, then the markets didn't rally quite as much. And the same is true of Asian markets. In fact, we saw some Asian markets start to pull back. Tech stocks continue to do well. Now, Facebook announced a new feature that it's going to be bringing out, which effectively enables people to open shops on Facebook. So you'll be able to buy via Facebook. So they're taking on Amazon and eBay effectively. So taking advantage of this trend that's been forced upon us largely by the coronavirus outbreak. And we've also seen, I mentioned tech stocks there because we saw the share price of Facebook rally to new all-time highs. And funnily enough, we saw Amazon's share price rally to all-time highs this week. So if you hold any funds that invest in those particular stocks, you would have done quite well this week. But we did start to see some value sectors and some cyclical sectors start to pick up and actually outperform the wider market. So financials had a good week despite Warren Buffett's disclosure. And energy stocks started to form a bit of a rebound as well. They'd been laggards over this coronavirus outbreak, largely because of the tumbling value in the price of oil. So we like to see some rotation in stocks because rotation is the lifeblood of any rally, of any bull market. You can have sectors like tech doing a lot of the heavy lifting, but at some point, other sectors need to join in so they can share the burden, because if we get a pullback in tech stocks, it would be bad for the overall market. Having said that, we definitely have the winners and the losers within this coronavirus outbreak, and tech stocks continue to be the overall winners. And it does raise the question, will we actually see a market where we don't have so much of that rotation? If we have the coronavirus lockdown extended over a period of time, we are in unprecedented times. That word is bounded about a lot. But as we've not been in a lockdown like this, could it just be that we might see certain sectors be winners for an extended period of time? So like tech stocks, those stocks that are particularly focused on buying online from home, those being winners that already make up a large portion of some of the indices out there, like the S&P 500. So they're actually giving this inflated view of the US equity market and global equity markets, given their size, when lots of the underlying stocks within those sectors aren't doing so well. So could it be that that actually becomes the norm, that we don't see this rotation and that the market can keep pushing higher because these stocks can do a lot of heavy lifting? We'd have to wait and see. But funnily enough, there are other winners that some people won't have noticed. Gold miners. So mining stocks, companies that mine gold. The gold price has been going through the roof at the same time as equities. Funnily enough, the correlation between the price of gold and equities is unusually high right now. Now that is unusual because normally gold is a haven asset, and that's often when stocks pull back, you tend to see gold start to perform or outperform. It's not a given, but the relationship between the two has been quite positive of late. So it's started to become increasingly positive. So they're moving in the same direction. That is unusual. We'll have to see if that breaks down. But what it does mean is gold mining stocks have been going through the roof. And in fact, gold mining stocks have outperformed tech stocks of late. Now, before people rush to go and buy gold mining stocks, you have to bear in mind they're incredibly volatile. So you imagine the price of gold is volatile, then gold mining stocks take it to another level. Now, gold mining stocks have also been perhaps undervalued in the last couple of years. So their valuations have been attractive. So when we've had this spike in gold, this FOMO in equities generally, people have rushed to gold mining stocks. So we have to be careful and watch to see what happens there and if that unravels. But if we go back to the wider indices, this week on 80/20 Investor, I produced a technical analysis piece. So that's where you look at the markets, the indices, the movements in them, and look for lines of resistance and support that could perhaps give you an indication of where the market might go in the future. Think of it like a weather report. It's not set in stone. It gives you a possibility that it might rain or it might be sunny. So I won't go into too much detail, but to take two of the indices I looked at, the S&P 500, the 3,000 level is key. At the moment, we're trying to push up towards that. I don't think we can understate how important that level is. If we breach that, then it could well be that the market then bursts higher and tries to ultimately head towards those all-time highs. It's proven very tricky. The market is stalling around sort of 2950, 2970, and continually seems to pull back. It's trading in a very narrow range, typically between about 2950 to sort of 2740, that 200-point range. So on the downside, if we break below 2740, then the market could unravel. So keep an eye on those levels. Don't become obsessed with them, but it can show you perhaps where the market might go next. We're getting a bit more breadth in the market, which is obviously a positive. So more stocks are indeed starting to enjoy the upside. It's not just the tech stocks. And as I mentioned earlier, financials have started to see a little bit of upside. So we're starting to see some positive news there. We want to see if that is sustainable. The cyclical sectors are starting to join in some of the uptrend. And it's not just tech stocks and healthcare sectors. If you go across to the FTSE 100, now the FTSE 100, the 6,000 level seems to be the sticking point. It is regularly broken up there in the last month or so, got to 6,000, just either high-fived it, just pushed over and then pulled back. On the downside, 5,000 looks to be the floor of the market right now. So that's a 1,000-point range. It's a big range. But if we can push convincingly above 6,000, then have a look at your stock app on your phone. You can see those levels. Every time it gets near it, it's been butting against it. We need to see it push higher because the FTSE 100 is a long way below its 200-day moving average and its recent highs in February, unlike the S&P 500 in America. Now, other global stock markets resemble the FTSE 100 more than they do the S&P 500 in their performance. So they haven't enjoyed as strong a rally as we've seen in America. The other thing I just want to finish on is keep an eye on the value of the pound. Now, when we had the Brexit deal come along and then we had the election win, the landslide election win by the Conservatives, we saw the pound rally to $1.30. And then we've had it pull back since then, largely because of the realities of what will happen in Brexit. We're in a transition period. What sort of deal will we get? But we've also had the government's response to the coronavirus come under scrutiny, which has put more downward pressure on it. The dollar has strengthened. It always tends to strengthen in periods of economic uncertainty and recessionary periods like we are now. So that kind of double whammy has caused the pound to tumble down towards $1.25, $1.23, and down towards $1.22, where it is roughly now. And of course, we've got Brexit uncertainty rearing its head once again. So what that all means is there's more downward pressure on the pound, and we could start to push possibly down towards that $1.20 level. There are some key levels you need to watch as support if we break through. If you want to know more, go and look at the research on 80/20 Investor. You can take out a free trial. So those are the things that you want to be watching in the coming days and weeks ahead. As long-term investors, you don't want to obsess about it, but it's worth just keeping an eye to see what the market is doing. And one last sort of macro theme, the US-China trade war seems to be rearing its head again. At least Donald Trump is throwing around accusations on Twitter. So that's causing a little bit of uncertainty in markets. But we'll have to see what happens in the next sort of days and weeks on that particular topic. So that is it for this week on Damien's Midweek Markets. As ever, you can get in touch with me, Damien, at moneytothemasses.com is the email address. Money to the Masses with the number 2 is the Twitter handle. Of course, we're on Instagram. Do subscribe to our channel on YouTube so you can see the videos of all the things that we do, and do join our Facebook group. You can find it at facebook.com/groups/money to the masses.